Okay. All right. Hello, everybody. Welcome. We are going to get started. Couple of minutes. All right. So I want to make sure that we are recording where we're supposed to be. All right. So I am excited to share the calculations for today because we are going to be looking at sort of like a hotel retirement campground situation. And so I'm going to run through a sample calculation on that. And part of that calculation includes calculating how much of the percent LP that you're going to have to give away. So if you're not familiar with the LP stuff, hold on tight because we'll get into some of that. And the analysis that we are going to do today can be applied to a bunch of different businesses, plus the land. As you guys know, I am looking at a lot of businesses, and one of our first criteria is that it has to have the land with it. So we're not just buying an existing business. Okay, so before we get into all of that, um, my name is Hong Liu, and I am with Cash Property Inc. And today we are going to go through an analysis along with answering. Let's see, how many questions do we have here? Yeah, two questions that we're going to answer. And okay, so before you go and take the calculations and implement anything that I suggest on the show, please go and talk to another investor, talk to your financial advisor, make sure that the ideas that I'm presenting are right for you, because they may not be. Okay, there's certain levels of risk and skill set and partnerships that need to go along with these. So welcome to Money Matters. We are April the 15th already. So yeah, insane how fast this year has gone by, right? And we say that every year. Okay, so welcome. So my name is Hong, pronounced like Hong Kong. All right, so let's keep going here. Okay, so let me share the spreadsheet and share screening here. Okay, so let's see here. Okay, so I'm hoping that these calls will help fellow accredited investors make, sound decisions on the investments. Because what happens, in today's market, it's sometimes a little bit difficult to make good decisions, especially if we don't understand the numbers and so forth. So part of what I'm hoping to do is give you the confidence to be able to look at your opportunities and be like, yes, this is a good one. No, it's not a good one, and be able to do that fairly quickly. Okay, so this one can be applied to hotels, motels, RVs, retirement homes, any sort of types of business like that. You could also apply this to multifamily, but usually for multifamily, I use my other spreadsheet, the one with the with just the rooms and the expenses. But you'll see from this analysis that it is pretty much the same type of calculation. Okay, so let's go through this particular sheet, and then I'll point out a few things so that when you're doing this analysis, you're able to do this on your own. Okay, if you do get stuck, please reach out to me. There's my QR code. It connects right to my schedule, my online calendar, and we can, have 20 minutes to chit chat about the spreadsheets and whatever challenges you're facing right now. Okay, so in this scenario, I'm running a hotel calculation, and usually I go with like a low, mid, and high rate for, and it doesn't really matter if it's like a campground or a hotel or anything like that. You're still going to have your low, medium, and high rates. So you put that in, and now I've set this up so that I can run this per week, per month, or per night, right? Because with a hotel, you're usually at a night rate. If you're doing, let's say, a retirement home, then you're going by month. If you're going maybe with a campground, then you might be by week or by night, right? Okay. So in this case, let's say we're going to go by night. Okay. So let's say on the low end for, let's run this for an RV ground situation here. Okay, so with the RVs, we're going to have cabins and tents. Okay, so in this case, what I've done here is I've just put in, let's see here. So I've got rooms, and I've got one room here, and I've got rooms for staff and other income. So this other income could be like if you have a store on site, if you've got charges for parking, what else? Laundry, a water park situation. So any additional stuff that you could charge for, along with, let's say, firewood. Okay, so you could add this as many things as you want here, right? So just add it down. So let's just say on a per night basis, on the low end, okay, for a campground, maybe 60. And then on the high end, maybe $100. Okay. So you're going to want to know what type of services your campground is going to offer. So in some of the campgrounds that I've been looking at, you'll have tenting, you'll have cabins, and then you'll have full service RV sites as well. So you're going to want to account for all of those in here. So let's just say we're going to add this in. Oh, what does this say? Oh, I've got an error. Okay, so let's just leave that for now. Okay, so we're saying per night, we're going to range between 60 to 100. So I have a formula in here that takes my low and my high and just gives me an average for my middle, right? So I can go anywhere from 60 to 80 to 100. So I'm running 3 scenarios at once. And so I'm going to say, okay, for my RV, so let's just say these are tents that I'm going to be charging here. So if I have 50% occupancy for the course of the year, so you're going to want to account for, is it seasonal, is it full year, and then how much is the occupancy actually going to be. So let's just say in this case, I'm running a 50% occupancy rate for 1 full year. Okay, so that's per night. So I'm basically going to say, okay, roughly I'm going to get about $30 per tent. Okay, so now if I have a 100 site campground, then if I have 50% of that rented out, then I'm going to be making $3,000, okay, per night. Okay, now you can see the scalability here, because now what I'm doing is I'm taking this $3,000 a night and I'm multiplying it, timing it by the number of days in the year. So from 3,000, I'm making over $1 million. So you can see the scalability in this, right? Which is why, multifamilies, products or assets with multiple sites is such a great avenue of multiplying and leveraging. So let's just say, for example, if you're doing warehousing, well, it's the same thing. You're renting the space of each of the warehouse. And as you increase the number of storage spaces, your profitability, the amount of money you can make, it scales like it's hard to imagine sometimes unless you actually sit down and start thinking about the scalability of this. Okay, because look at this. If I change, so let's just look at the low number here at the $60, right? If I had 100 units, but I go from 50% occupancy to 60%, okay? Look at what happens to this 1,095,000, okay? Just from increasing the occupancy by 10%, I've gone up about $300,000 in the course of the year, right? Like that's huge, okay? So now if I'm charging up on the higher end at the $100 a night, okay, I'm way into the $2 million a year mark. Okay, isn't that crazy? Okay, so that's the income portion of this spreadsheet. And this is the same income calculation that you would have on residential or multifamily. It's the exact same calculation, right? Like you want to make sure you know what your income is. Okay, then you go into the expenses. Okay, now when we're doing multifamily, you don't have as many expenses. That's why on the other spreadsheet, it's your standard, your property management, your advertising, your landscaping, property taxes, insurance. Okay, when you are doing a business, you have the exact same expenses, but more, okay? In the sense that now you may have to get phone, internet security. You may, like I always account for legals and accounting and licenses in multifamily too. But in this case, you may also need to account for HR, okay? Especially if you're hiring staff. And so this is So there's one here for staff here. This one is different from property management. Okay, so in multifamily or like in residentials, you do have a property management line, but you could self-manage. Okay, so in a business like this, I can self-manage this, but I can't do the job of 10 people or 20 people, depending on how big the operation is, right? And also, because it's a business, you want to be operating outside of the business, right? So you want to make sure that there's enough revenue coming in to justify paying somebody like you to do your job. Okay, because part of it is that you don't want to be working in there, you're not trading, like you're not buying this opportunity for a job. Okay, so just keep that in mind. So there is a staff line here, then there's like say gifts and advertising, so that I also have in my multifamily. But here I want to make it a line item number. So property taxes is here, maintenance, insurance. So all of that is the expenses, and you can have more as well. Okay. So I've got a line for other because there's always stuff that you miss. Okay. So you put those expense items in, and then you put like say low, medium, and high. Okay. So usually what I do is I just put a percentage rate in there, and then I let the Excel sheet calculate. So the only exceptions would be, let's say, from the staff, right? Or stuff that it doesn't matter what you like, the fixed expenses are your fixed expenses, right? Like it's not a variable expense. So for example, the staff, at some point, there's a maximum number of staff that makes sense. And then there's a minimum number of staff that you have to keep. So the same thing with taxes and insurance. Like those things don't increase just because you have more people staying in your facility, or people like the number of clients that you have, or your sales, right? Your taxes is your taxes on your property. Whereas let's say your utilities may go up a little bit more because if you have more people at your campground or more people in your multifamily, then you're going to have a little bit more utilities to pay. Or like, let's say if you've got a food expense here, right? Well, the more people you have, the more food items you're going to have to buy and staff to pay for it. So here I've put in a minimum staff saying, okay, at a minimum, we have to have 8 staff. And then on the maximum, this is based on this formula over here with staff, on a max, we would have about 10 staff. Okay. So this was on, on some previous opportunity I was looking at where I said, okay, at a minimum, we're going to have 8 to 10 people working there. So this is roughly how much the pay is going to be. 624,000. So I have to make sure that once I'm at my high level occupancy, that I am able to support all of these expenses, including the staff. Okay, so then I've got landscaping, all of that. So these percentage are rough expenses. And once you go into your due diligence, you'll be able to get a good sense of that. The great thing about buying an existing business is that you can ask for their 2 to 3 years of previous financials. So then you're making a better estimated guess of how much it's going to cost you to operate this. Okay. And sometimes when you're analyzing the data, you'll find that their utilities are like, let's say 8 or 10%. And you're like, why are they paying so much? And that may be an opportunity for you to improve on some of the expense numbers, right? Because you definitely want to come down on the expenses as much as possible. Okay, so in this calculation here, we've got, about 73% in expenses. Okay. And then, so as an expense ratio, that's what's calculated here. So as you can see, as we increase the occupancy, our expense ratio actually goes down because the fixed portions stay fixed regardless of the number of people we have. So the more people we have, we're able to reduce those fixed expenses significantly. So then that's why we're able to go down in this case from 73.8% to 61.9%. So that's a huge gain. Okay. So in the expenses, what we're calculating here is about 970,000 to about 1.35 million in expenses. Okay, which is a lot. but you're making 1.3 to 2.19 in expenses, which is really good. Okay, so then these numbers here is just dividing it per month, because a lot of times I look at these numbers and they're so big I can't wrap my head around it. But then what I do is I just look at it at a per month basis, and then it makes it a little bit more manageable, right? And also because I use these monthly numbers to calculate and build out my monthly spreadsheet. So on the bottom, you'll see I have a tab here for monthly, because I'm going to take that expenses and make sure I have enough. Because as the money's going up and down, like the income is going up and down, your expenses are probably going to be pretty steady throughout the course of the year. So you want to make sure that you account for that negative cash flow during some of the low months. Okay, so I do a cash flow before debt servicing. So this would be my NOI, right? So basically my income minus my expenses, that's going to give me what my cash flow is, my NOI, my net operating income before debt servicing. So I like to know what that number is, because then from there, I can go and calculate my debt servicing, and the debt servicing can come from multiple ways, right? And so that number will change once the debt servicing goes in. So through the course of the year, this opportunity, if I was to go from the low to high, I would make anywhere from $343,000 to $834,000 a year. So right off the bat, I'm like, wow, okay, even at my low price, if I'm at a 60% occupancy, if I'm generating 343,000, this is a great opportunity. Okay. So, this is, so it's now, of course, this is all relative, right? So let's just say now, okay, I'm going to put this back to 50%. And so now you can see that this annual cash flow before debt servicing went down to 179,000, right? So, okay, so now I'm going to keep going here. So now let's just say that the purchase price here is 4 million, land transfer tax. Okay, so this is what I was looking at an opportunity with a fellow investor, and they did their calculations and did not even realize that there was land transfer tax in their opportunity. And so that for me was a huge red flag, because if you are the main person analyzing the deal and you don't know that there's this land transfer tax, that's $50,000, like, potentially, right? Now, in this case, because the purchase price is going to go up, it's going to be a higher land transfer tax. Okay. And then let's say in Toronto, we have double land transfer tax. So it's even going to be more than the 50,000. Okay. But what I'm trying to get at here is that if you're running the numbers, if you're responsible for the numbers, you need to make sure that as part of your closing costs, you have the relevant numbers that are going to affect your purchase price, okay, to close. And so with this particular situation, it really raised a lot of red flags for me, because this individual did not know that there was a land transfer tax and did not know how to calculate it. Okay. So what I would say here is that, before you go and present your opportunities to family and friends, make sure that you know that there is a land transfer tax. And if there is one, how do you calculate it? Okay. So in this case, I'm just going to put 50,000 as a placeholder, and then part of my due diligence later would be to go and calculate for sure how to get that number. Okay. So I always like to put in a 5% closing as a minimum. Okay. Even though I'm the buyer, I'm going to put 5% down. I've got an interest rate here of 7% because this is a commercial purchase. And so, usually 7% is a good number. Part of my due diligence afterwards is I would stress test this at 8 and 9 and 10%. Okay. If you can get an interest rate at 5.5%, 6%, that's great. Okay. But you don't want to run your initial numbers on a low interest rate just in case. Okay. So then the amortization year, so that's the total amount of period. So in this case, for a business, it's 15 to 20 years. Okay. So then the monthly payment, so this is per month, the interest and principal payment on this mortgage that I would potentially have It's just a calculation in Excel, okay? So you don't need to worry about it. If you happen to have one of those fancy HP calculators, you could do it manually as well. But I always like to use the formula in Excel. Okay, and the formula in Excel is the PMT formula. So if you don't know what that is, just Google the PMT formula in Excel and it will walk you through it. Okay, so the way it works, it's a negative number, the negative sign before the PMT. You take your interest rate, always divided by 12, and then the number of uh, payment periods. Okay, so in this case, it's 15 years times 12. Okay, and then what is this one here? This one is, oh, my loan value. Okay, so it's basically my purchase price times um, my LTV. So in this case, I'm running it with 65. If you're saying, Hung, multifamily is 25%, right? Okay, yeah, that's different. Multifamily is a different asset class, right? When you're doing hotels, motels, any sort of business, 65, 60% LTV is usually what you're going to get. Okay, so I like to sort of err on the side of caution here. So I run it with 65. Part of my due diligence later on would be to run it at 60, 55, okay, just to make sure that we have enough cash coming in and that we raise enough money. Okay, so this number here is now 23,000 per month as a mortgage payment. So that means this cash flow before debt servicing needs to be higher than my monthly payment, because otherwise I'm going to be in the negative. Okay, so you can see here the next section is this my cash flow after debt servicing. And you could see once I'm on the low end, even though I'm making 180,000 a year, okay, and in this case, $15,000 a month in cash flow, I'm actually in the negative once I go in debt service. And I'm in the negative by 8,400. So for me, that's a bit of a risk there, because if I'm operating at the low end of the rental scale and I'm at 50%, it means I'm going to be in the negative, right? So then part of my calculation is to say, okay, well, where is my break-even point? At what rate do I need to have this at? Like, so does it need to be 70 at 50%, or does it need to be $60 at maybe 60%? Okay, where is my break-even point? Okay, so then from there, I can sort of gauge what is the risk and how to mitigate that risk. Okay, so then that brings us to the cash flow after debt servicing. Okay, now one option is to say, especially if the traditional lenders aren't going to fund you, you may need to do interest-only payments, okay, to a private lender. And this is where you run the opportunity saying, okay, worst case scenario, I have to go to a private lender and I have to carry this for 1 year or 2 years, right? Before we stabilize, before we force the appreciation, before we do whatever. Are we able to carry this with a private lender? So as you can see, even at the low rate when it was at like 5%, 7%, we couldn't carry this opportunity, right? So to do private lending at 12% in this particular case, there's no way we're going to be able to carry it. So if my research shows that, okay, 50% occupancy at $60 is the average, like that's what everybody's doing, then there's no way this opportunity would make sense, right? But look at this mid-range one. Even with private lending for 2 years, okay, we would be cash flowing about 4,800 a month with private lending money coming in at 12%, 65% LTV. Okay, so if I can get this business to operate at $80 per night at a 50% occupancy, and I've got expense ratios about 75%, I'm still doing pretty good at $4,800 a month. Okay, so that's one way to look at it. Okay, the other thing to keep in mind is, which is what we're going to do the next part of the analysis on, which is actually really, it can be a bit of a challenge to get your head wrapped around, because you don't need to have $4 million in this case, because we're buying a $4 million opportunity. Okay. You don't need to have $1.4 million in down payment of your own money. Okay. So let's go into the second big part of this calculation here. Actually, it's not the second big one. The second big one is the expense ratio, to make sure that you understand your expense ratio. So the first one is your income. The second one is your expenses. The third one is knowing what your debt service is, right, from different money sources that you could have fund your opportunities. So that's the third one. So this now is the fourth part of your analysis, which is your partners coming in. Okay. So one of the big things that I always say is, you know what, if your opportunity is good, you'll be able to find people who will want to come in with your opportunity. Okay. So how do you calculate that breakdown? Okay. So let's get into that right now. So in this particular situation, we've got 1.4 million in down payment. Okay. That's based on a 65% LTV at your $4 million. Okay. So that's 1.4 million in down payment money that you need. And then you have 250 in closing costs. Okay, so this is a calculation based on what do I have? The 5% closing of my purchase price plus my land transfer tax. Now you could have other things like renovation money. If you know that there's other things that you have to pay for, you definitely want to include that in this number as well. Okay, then I've also have a 200K, and this is a random number that I just picked up from the sky to put it in my spreadsheet, because I want to make sure that I have an initial setup. So this initial setup would be, let's just say, it's a one-time initial payment that I would have to make, like say advertising, any sort of community outreach, any sort of major renovations. Those things I want to make sure, because I'm going to need that from day one to run this opportunity. Okay, so I add all that up and I get 1.85. Okay, so as you can see, this is a significant jump from the 1.4. So that means that I need to raise or have access to 1.850 from the day, like on the day that I close. Now this 200, so let's just say I say, okay, well, I have 30 days to do some forced appreciation. I have some like 30 days to do whatever. So this 200,000 doesn't need to be needed on the day of closing, but I do need to have it available, let's say in week 1, week 2, week 3. Okay. So make sure you're realistic about how quickly you need this initial money. So I like to put that in so that I know that I'm going to raise it and have it available from day 1 to run on the project. So that means I'm going to need to raise 1.85 million. Okay. And so if I can find investors to come in at 100,000, they're going to get 2.7% based on a 50% LPGP. So it's a 50-50 split in this case. If it's a 40 for me and 60 for the money partners, then this 2.7 is going to change. Okay. So one of the things that I would caution here is, because if I need to raise 1.85 million, I don't want to be bringing in 100,000 from individuals, because then now I'm going to have 18 partners. Okay. Really, I just want maybe 1, 2, 3, 4 partners at the most in each of the opportunities. Okay. So what I'll do is I'll run this number, this mini table here. So I'll walk you through how this calculation works here. So there's 50% of the pie is going to go to the limited partners, the money partners. Okay. And so we need to raise 1.85. That's going to cover the down payment, closing, and the initial costs. Okay. Now, this is critical that you understand this portion, because if you don't raise the full amount, then you're going to run into some financial difficulties once the business is up and running. So a lot of times when I do my projects, I'll have my reserve available so that if something happens, then I don't need to go to my money partners all the time, right? Like I've got cash available to influx into the project. Okay. So in this case, what I'm doing is I'm saying, okay, I'm going to have 4 partners, and each partner is going to put in, their own amounts, right? So I'm running some numbers to show you what it looks like here. So 600,000 for partners 1 and 2, and then 300,000 for partners 3 and 4. Okay. So in total, they've got 1.8 million. Okay. So we need another $50,000. Okay. So this is not the ideal case. Like, it's not a bad situation to be in, but it's not ideal. So let's bump this guy at the bottom down here to 350. Okay, so as you can see, like, my spreadsheet converts it to tell me, okay, I've raised enough money, right? So I can stop raising money. And this is the breakdown of my 4 partners now. So I've got 100% in, and each person has, let's say, 32 or 16 or 18% in, okay? But this is based on a 50% LP. So what does that mean? Well, if we didn't do another step on the calculation, this is the breakdown of the partnership by ownership. Partnership by ownership. Okay. So it would equal to that 100%. But I'm also part of the team. Okay. So I'm part of the GP. So in this case, it's a 50-50. So that means the LPs are taking 50%, not 100%. They're taking 50%. So that means then the further breakdown is whatever percentage they put in at 50%. Okay. So LP1, the limited partner person, the first person, puts in 600,000, sorry, they put in 600,000. They get 16.2% of the LP. And then let's say partner number 3 puts in 300,000, they get 8.1%, okay, of the LP. So the total of all the LPs is 50%. Okay, so that's the math that's behind this LP calculation. Okay, so this one here, I would say, is like a really important portion to understand. And when you get to that portion, then when you're talking to your partners and stuff, that's how you want to present it. Okay, so let's see here. So what else is good to point out here? So yeah, no, that's so if you can get your calculations to this point, and that even with private lending, at a 12% interest rate, if you're cash flowing, let's say 5,000, and then on the high level, we're cash flowing 20,000 a month. Okay, this is a good opportunity to pursue. Okay, so if you have any questions or comments, please let me know. Do not hesitate to reach out and let me know what your comments and your comments. I'd love to, learn what other people are thinking about. Okay, so good. So we will move those 2 calculations off the board. Okay, now where are those questions? Because I know that we came, buying existing or build. Yeah, so we'll have to do that calculation another time. Okay, so I did have some questions that came through, and okay, let me answer this one here. I'm not good at Excel or analyzing. What should I do? Okay, so okay, so I do have 3 suggestions here. So number 1 is you partner up with somebody who's good at analyzing. Like myself, right? Like, there's lots of people out there who love Excel, who can analyze a deal and do it fairly quickly. Okay, so and that's the benefit of partnering up with somebody, is that you can partner up with somebody who will save you a lot of time, because they can, like, I can analyze a deal in 5 or 10 minutes and then be like, yes, this is worth continuing. No, it's not worth continuing, right? So if you can get like a yes, maybe answer and then continue it or discontinue it, that will save you so much time. And if you don't like the analysis, if you don't like Excel, well, what do you bring to the table? Like, what is your strength, right? Because like, there's, like, I spend a lot of my time analyzing, but at the end of the day, I could partner up with one of my partners. He's great at negotiating, right? He's great at finding the opportunities, right? So then that way I'm not doing all the different roles within a potential partnership. Okay, the second thing would be to Okay, if you know you're not good at it, learn it. Okay, there's so many YouTube videos, there's so many like programs out there, like courses that you can take. I only got to where I am with my Excel stuff because of my engineering course. I don't think I would have done this much Excel, except that in engineering school we had to do everything in Excel. Okay, so like programming and yeah, figuring out some crazy stuff in Excel and writing. Um, yeah, a lot of stuff in Excel. So, like my skill set from Excel is from, 5 years of engineering school. So the second one would be to learn it. Okay. The third one is not, it's one that I would recommend, but take it with a grain of salt because I have seen um, I've had enough encounters with this that it's actually backfired. Okay, so I say it with a grain of salt. So the third one is to pay for the online programs that do the calculations for you. Okay, so there's Bigger Pockets, there's Deal Check. Those are the two that I've used in the past. I like those platforms, and there's lots more out there. Okay, but here's the caution that I put with that one is that they may not be made for Canadians. Okay, meaning that it's a generic calculator, meaning that you really have to understand your numbers because they could be for the US, they could be for Australia. Okay, I came across one spreadsheet online that was for India, and I'm going through some of the stuff, going, I don't even know what some of these terms are, right? So I would caution that if you're going to use the online calculators that are available, is one, you still need to understand the numbers. Okay. It's not enough for you just to input the numbers and then look at the final cash flow and be like, oh, okay, this opportunity is great. You have to still be able to explain all the ins and outs and know when the spreadsheet is giving you an error. Okay. So, like earlier, I mentioned to you about that fellow investor who didn't know to include land transfer tax. Well, in that case, he used one of these online platforms and he didn't know about land transfer tax. And the system didn't say, hey, did you include land transfer tax? Right. It just was one of those things where, it's a garbage in, garbage out. It's a one-way street on analyzing. Like there's no feedback coming at you, right? And so if you don't know if it's a good number or a bad number, or if you don't know how much, if the quality of that number is not good, well then you're just not going to know. Okay, so that is what I would say about, okay, if you don't know how to analyze, then what do you do, right? Okay, so those are the three. Okay. Okay, let's go into this one question here. And this is actually pretty interesting because I've had this question come up from multiple people in the last couple of weeks. And so this one is around, you know, and I don't want to say that it's from a younger generation that is asking this question, because this also applies to individuals who just don't have a house, right? Or who don't have a bunch of investment opportunities right now. So how do you get into your first home? Okay. So when I started out, I started with $10,000 and I house hacked. Okay. So house hacking is still a very good strategy. And if you can house hack, you should totally house hack. Okay. So house hacking. And if you don't know what house hacking is, it really is just where you live in the house and you have other people living with you, either as roommates or if you have multiple units, then you rent those out. Those individuals will pay rent and help cover the utilities, help cover the mortgage. You may still need to pay a little bit out, and or maybe equivalent to like what you would pay for rent somewhere else, but you now have a physical property where you're paying down the principal. Okay, so you're paying down the mortgage. So house hacking is one idea that I would still highly recommend. And if you want to research more about house hacking, there's tons on the internet. Like when I started out, house hacking really wasn't well known then. Okay, so house hacking is definitely one opportunity. The second one is co-sharing. Okay, and co-sharing is where a group of owners own the physical property, own the house, and each of you guys pay portions of the space. Okay, so it's like a condo, it's like a strata, okay, but you you're getting in usually is a smaller price point, and you guys are self-managing. Okay, so in Vancouver, okay, the house prices are anywhere from like 2 million up for a single family, okay, and condos are like, the tiniest condo imaginable is like 700,000, 800,000. Okay, so the price point of getting in Vancouver is very tough, and so co-sharing may be another way for you to get um, into home ownership. Okay, so when you're looking on Realtor, or if you're talking to your agent, like in my area here, there was 4 co-sharing opportunities in the last month that I came up with, when I was searching, and they ranged from 500,000 to 700,000. Okay, so that price point is not outrageous. It's not unattainable. Okay. Now, the challenge with co-sharing is that the lending from the bank is slightly different. So you do need to have like a higher down payment. You need to be willing to work with the other owners, right? Because everybody now has a say in how things are operated. Everybody has a vote. And so, but it's a way to grow your net worth and your wealth through home ownership if that's what you really want. Okay, so those are 2 of the ways to do how 2 ways to get into real estate if you aren't in real estate yet and you want to just like get into your first place. Okay, now with both of these, you do need to save a little bit of money. So like meaning you do need to have some cash available. So whether it's your 9 to 5 and you're saving, or the bank of mom and dad, your RSPs, like the first time home buyers program, depending on where you are, if you can still access the first time home buyers program. So yeah, though that's my comment on how to get into real estate right now if you're not in real estate right now. Okay, so if you have any more questions, please email, text it to me over here. Love to talk to you if you are a fellow accredited investors working on opportunities and want to bounce the idea around. Happy to do so. All right, I will see everybody next Monday. Thank you for tuning in. Bye, everybody.